Welcome to this week's version of Nickels and Dimes, our weekly video series. Well, the markets continue to decline, and particularly the equity markets and obviously the bond market as well, as we see interest rates going up. What is going on with the market? Folks, you turn on the news, you read various headlines, the financial press, the mainstream, everyone is talking about the decline in asset prices, particularly the equity markets. Of course, if you're invested in the crypto markets, in cryptocurrencies like Bitcoin and Ethereum, the two largest, you've obviously seen very big losses or declines. So what is going on? We've talked about this most recently. It's a risk-off trade. For example, or what that means is the asset classes like high tech, big tech stocks, or even growth companies or cryptocurrencies are generally perceived as more volatile, more risky. And there's a point in time where asset managers, investors simply don't want to take the risk. And if the company, for example, is a high growth company, there's a reasonable chance they don't necessarily cash flow. In other words, they're not profitable. So those companies tend to be the ones that, in an environment that is concerning, they get sold off likely the quickest and the most rapidly and the first. Why is all this happening? It's simply because rates are going up. The Federal Reserve has been committed to slowing down inflation. And one way they do that is obviously raising interest rates to start basically decreasing demand, and hopefully that reduces inflation. So all that to say is, where are we in the market cycle? Now so we'll jump right in to that. So I wanted to note something I think is very important. You have to understand where we are in the market cycle. Last year, in fact, I highlighted it here, June 22nd of 2021, I did a video. It's available on our website. The video was titled 5 Characteristics of a Market Top. Again, here's a screenshot of the video. You could check out the video on our website at nicholswealth.com in the video tab and search for it. It's about a 15-minute video. Why did I do the video back then? It's what you would suspect. Back then, we saw characteristics that typically show up when the market is topping out. In other words, these characteristics, and I picked 5 of them, typically show up if you look at historical tendencies since the equity markets around the 1900s. These types of characteristics typically show up when the markets are at a peak. Now, again, you could refer to the video, but I'll just share the 5 that I discussed: excessive bullishness, something called a put-call ratio, extended valuations, excessive margin debt. We've talked about that a number of times in recent videos, and bubbles or manias. Well, again, as we say, the past may not necessarily equal the future, but it tends to rhyme. Again, there's no perfect one-to-one. In other words, what happened in the financial crisis, or the dot-com bust, or when we had interest rates, in the mid-teens in the 80s, what happened in the past may not necessarily equal the future. But again, history is a reasonable guide to what may happen in the future. So again, check out that video if you'd like more information on. But again, we saw some of the things and causes that created this big decline, and one of them was a very popular ratio. Warren Buffett sort of coined it. It's called the Buffett ratio, where they look at the total market cap, in other words, the total value of all equities, divided by GDP, divided by the gross domestic product. And generally speaking, to oversimplify it, historically speaking, that ratio is a 0.78. Okay, that's important. Why? Because in December 31st of 2021, so 6 months ago, at the end of last year, that ratio was at a 2.82, 3 to 4 times the average. This basically says that stock prices were 3 to 4 times the on average. So imagine going to a store and wanting a product and paying on average 3 to 4 times more for it, based on what its historical norms is. That's where we were at the end of last year. By comparison, again, the dot-com phase, if you will, at the peak in 2000, that ratio is a 1.88. Again, historical norm is 0.78. The dot-com peak was 1.88, and we were at, per this ratio, at the end of last year at 2.82%. That was very, very concerning. Again, these types of things where, for example, we have margin debt at an all-time high and valuations extended beyond norms. These things don't happen at market bottoms. For example, they didn't happen in March 2020 when we hit that coronavirus low. They happen at peaks. Again, most recently. So again, back to that video if you'd like more information. What's going on now with the market? Again, we talked about rising rates. The Fed is committed to, at least per their messaging, continuing to increase short-term rates. You have to understand where we are in the market cycle. Again, as you would imagine, not every market cycle is the same. So where are we currently? And if you look at the far right, this is earlier this year. I've shown this chart, if you watch our videos, a number of times. This is the S&P over the last 25 years. We were, if you look at the far right of this video, about at the beginning of the year, 48% above the average. Let's assume this white line is the average, compared to the before the financial crisis in 2007, we were 30% above the average, and in the peak of the dot-com bust, if you will, right before that big decline, the market was about 64% above the average. And why is this important? It's simply because the more stretch and extended we get beyond the average, as you would figure, the larger the decline. And this is what we're seeing. And again, if you follow our videos, we've been talking about this. Now, here's where we are. This is as of a few days ago. This is actually as of June 13th. We've had a big decline. So we are now still 19.5% above a moving average. Again, if you look at the past, in the middle of the screen here, the dot-com bust, you saw a huge decline. In the financial crash, you saw a huge decline on the far left side of the screen. This was the mid to late 90s, and then of course the big downturn we saw in 2000 and 2002. It's very important to know where we are in the market cycle. Now, I don't know, nor does anyone know. Do things get worse? Do things become more challenging? No one knows the future, but the reality of the situation is, as interest rates continue to climb up, which they are, of course, if you look around, inflation, mortgage rates, folks are struggling. That also means if cost of capital, meaning interest rates go up, companies have a harder time borrowing money, and of course that means it burns into their cash flow because obviously the cost of borrowing is more expensive. So all this does is put stress on the financial markets. It puts stress on companies' cash flows. It reduces generally speaking, their operations. It puts stress on their operations. So what's the solution, or what's the best thing you can do going forward? Again, understand where we are in the current market cycle, or any market cycle. Number two is you must have a sell discipline or a way to protect your money. And in our opinion, traditional asset allocation, where you simply buy stocks and bonds and diversify, is likely not enough. Now, why am I bringing this up? It's simply because if you own, for example, the average equity, you're very likely down over 20% this year. In fact, the S&P just hit bear market territory. Bear market territory is simply a decline of 20% from the high. Now, the NASDAQ is off over 30% from the high. The NASDAQ has gotten hit obviously harder, being the technology-based companies. If you're in the bond market, you're getting hurt too. The average bond, if you're looking at the aggregate bond index, is down around 10% this year. So if you're in a traditional stock bond portfolio, you're very likely getting hurt. So all that to say is, to my point, you must have a sell discipline, a proactive strategy, and a way to hedge your portfolio against large declines. And again, in my opinion, our opinion, it's simply not enough to stay in an asset allocation portfolio. Because again, most people know, particularly when you're near retirement or in retirement, your number one goal is what? You bet it. It's to preserve your capital. It's to make sure, or do your best to make sure the core of your portfolio and what you've saved, it will do its best, if you will, to stay intact. To that end, certainly we welcome folks to to visit our website and get a second opinion. What that looks like is having a brief conversation with us, answer some questions. We'll ask you some questions, and we'll certainly happy to sit down with you and see if we could be of benefit. There's a lot of noise out there, a lot of challenges. Things may get worse, folks. So, there's a very real chance the worst is not over. So again, if you'd like a second opinion, go ahead and check us out on our website to do that. Have a great day. Thanks for watching. Bye-bye.